Andrew Carnegie once said that 90% of millionaires become so through owning real estate. But in a world high-speed digital assets and 24/7 stock market, why does a dumb piece of dirt remain the ultimate wealth creator? Is it luck, or is the mathematical certainty behind property? Today we unlock the code of the world's oldest asset class. Welcome to TradingBits X. This channel is all about decoding the economy from the ground up. No noise, just signal. Until now on this channel we have discussed the theory of money, inflation, interest rate, and market cycle. But today we cross the bridge. We're moving from concepts to tangible assets. Real estate isn't just a roof over your head, it's a claim of specific coordinate on the Earth's surface. Before we dive into the how, I have a question for you. Do you currently view a home as an investment or just a place to live? There is a massive psychology division between those two answers. Let me know your statement in the comments below. While you're down here, hit that like button and subscribe. It tells the algorithm that you value deep dive financial education over get rich quickly noise. The economy of scarcity. Mark Twain famously said, "Buy land, they're not making it anymore." It sounds like a joke, right? But it's the most fundamental economic truth of real estate. Most assets are reproducible. If the price of Bitcoin goes up, more miners join. If the price of phones goes up, Apple build more factories. But if the demand for land in Manhattan or London triple, the supply of land remain exactly the same. This creates a permanent supply-demand imbalance. As the global population grows and urbanizes, more people are competing for a fixed amount of space. The land versus the structure. Remember, the buildings on top of the land is a depreciation asset. It rots, it breaks, it gets old. The land itself is the appreciating asset, is the scarce resources. Think about your own city. What was the cheap neighborhood 10 years ago that is now unaffordable? That's a scarcity action. The magic of leverage. This is where real estate beats almost every other asset class. Leverage. If you want to buy $100,000 worth of Bitcoin or gold, you usually need $100,000 in cash. But in real estate, the bank will often lend you 80% or even 9% of the purchasing price. The math of wealth. Imagine you buy a $500,000 property. You put down $100,000, 20%. If the property of the value goes up by just 5%, the house is now worth $525,000. You didn't make a 5% return. You made $25,000 on your $100,000 investment. That's a 25% return on equity. This is the other people's money working for you. However, and this is our TradingBits warning, leverage is a double-edged sword. If the market drops 5%, you lose 25% of your equity. Do you see that as a ladder to wealth or a trap to avoid? I want to see your debate on this. Comment down below. Cash flow and the yield logic. Wealth isn't just about what you're worth, it's about your cash flow. Real estate is one of the few assets that pays you to own it. While you wait for the property to go up in value, the tenant is paying you a rent. In finance, we look at the capitalization rate. The formula is net operation income divided by purchasing powers equal capital rate. If your rental incomes cover your mortgage, taxes, and maintenance and still leave you with $500 a month, that is a mailbox money. Over 30 years, your tenant essentially buy the house for you. You ended up with a paid off asset that you equity for only the cost of the initial down payment. This is the definition of building wealth while you're asleep. Locations and the network effects. You heard it 1,000 times. Location, location, location. But why? In the style of TradingBits X, let's look at the network effects. A property value is directly tied to the economic productivity of the people around. If a new Amazon headquarters open or a new software line is built, the utility of the land increases. You aren't just buying bricks, you're buying access. Access to jobs, access to safety, access to culture. When you invest in real estate, you're essentially shorting the dollar and longing human productivity in a specific zip code. The risk, the liquidity trap. We don't hide here. Real estate has massive downside. Illiquidity. You can't sell a house in just 2 seconds like a stock. It takes months. Concentration risk. If you have all your money in one house and that neighbor goes downhill, you're in trouble. The 3 T's: taxes, trash, and tenant. It is a business, not a passive hobby. This is why as you grow as an investor, you realize that owning property is just the first step. The real challenge isn't buying, it's building a portfolio. Real estate is a powerful pillar. It offers scarcity, leverage, and cash flow. It moves your wealth from the digital screen to the physical earth. But as we just discussed, putting all your eggs in one property basket can be dangerous. How do you protect yourself? How do you combine the stability of real estate with the growth of stocks and the safety of bonds without losing your mind? In the next video, we're exploring what Nobel Prize winner called the only free lunch in finance. We're diving into diversification. We will break down correlation, idiosyncratic risk, and how to build a portfolio that survives any weather, whether the housing market crashes or the stock market moves. Don't forget to share this video with one friend who is still paying somebody else's mortgage. Stop thinking like an owner, not like a renter. And remember, money, markets, we're trading the future. See you in the next one.